Hello, and welcome back to the Property Pilot Podcast. I am Brian Graham. This is episode 21, where we're going to be talking about different real estate investment exit strategies. So what does that mean? Well, going back to a few episodes ago, we talked about coming up with goals and coming up with strategies of how you're going to invest. And part of a business plan is to figure out how you're going to be making that money back. So when you buy an investment property or you buy a business or whatever it is, you need a return on that capital. So your return of investment obviously is going to be your cash flow compared to whatever amount of money that you put into it. So if you invest $100,000 and you make $10,000 a year net profit, that's a 10% return of investment. But how do you recoup or exit that business in order to get back all of your capital? So that would be your exit strategy. And in real estate, there's plenty of different exit strategies, some good and some, I'm going to say some that are necessary. Some good because it helps snowball your investment. Some are just simple to understand, but really, obviously the goal of investing is to build wealth and build your business. Whereas some of these strategies are used to cut your losses or get back what you can. They're a last resort kind of thing. So we're just going to get right into it. We're not going to really be talking about exit strategies as it relates to wholesaling or fix and flipping, because a lot of the podcast that I like to talk about has to do with building long-term wealth and long-term growth through, investment properties, rental properties. I'm not an expert in wholesaling. I'm not an expert in flipping. I do find myself to be somewhat of an expert in, long-term wealth, long-term rental properties rather. My wife is an expert in remodeling, and so we use those two fields of expertise to, build this business. I've never done a fix and flip. I've done a BRRRR. I've never done a wholesale. I do know a couple of people that do have fix and flip businesses. But these exit strategies, those are going to be short-term capital gains issues that those people run into. And those exit strategies are within 4, 5, 6 months time frame. My exit strategies, my buy and hold and / exit strategies are going to be 1 year plus. And I'll explain why that is as well. So again, we're going to get right into it. This is exit strategies for long-term rental properties. So the first one we're going to talk about is a traditional sale. Obviously, you know what that is. You buy a property, you list it on the open market. Your objective is to get the top value, top dollar that you can. This would be a situation, in my opinion, where you don't need the money immediately. You're trying to take advantage of current market conditions and capitalize on the amount of appreciation that's happened to your property, or you want to sell out of your property. Maybe the property is performing really well and it's a very high demand area and you want to cash in on it. Or let's say it's the opposite. The property's not doing so well, but the demand's still high and you just want to cash in on the property, get out of the headache, and you want to take that investment because you've recouped your money and you want to do something else with it, whether it's reinvest it or it's, buy something, invest it somewhere else, spend it on a family vacation, whatever it is. But it's a traditional sale. If you just use a real estate agent or not, and you list it on the open market, your objective is to get the highest value dollar possible. The next one would be a lease to own option. You've heard it called different things: rent to own, lease to own, a lease option. Those are all the same thing, tomato. So the purpose of this and what this means is I'm going to find a renter, and I may list this as a part of my marketing, but I'm going to find a renter and I'm going to offer an option for that renter to then purchase the property from me at a later date. This is a different version of an exit strategy, because let's say you want to buy this property, but for a fact you want to sell it at a later date. This way you can find your buyer the minute you buy the property by marketing this property as a rent-to-own option, so someone can then purchase it from you at a later date. I think the world agrees that real estate appreciates over time. So if on average the real estate market appreciates 3 to 5% every year, if I buy a property for $100,000 and then I find a renter that's willing to do this and we agree on 1 year later for $105,000, it's very likely that person may say, okay, I don't have the funds to purchase it from you now. Not to mention, as the landlord, you may not want to do that because then you have to pay short-term capital gains tax. That would be almost classified as a flip. But then that renter says, I don't have the funds to purchase now. I'll do that at a later date. And how you do that is up to you. A lease option can be done in many different ways. So you can say to the renter, hey, let's agree on $105,000 exactly 1 year from now. And I'll use, if that property was going to net cash flow 500 a month, you can say, I'll use $250 per month towards your rent and then, or sorry, towards your equity to purchase that home at a later date. So the landlord pretty much puts the $250 in a separate account, and that is applied towards that buyer's equity, because that buyer is only going to need 3.5 to 5%, depending on what type of loan they do, only going to need 3.5 to 5% down to purchase that property, which is on a $105,000 home, you're talking about 5 grand, give or take. So if you take $250 a month and put it into an account times 12, you're looking at just under, or let's say about $3,000 or $2,500. Yeah, $3,000. Sorry. So you're looking at $3,000 that person now gets to apply towards their down payment. So now they only have to save on their own an extra two in order to buy that property. And they don't have to haggle with real estate agents. They don't have to do anything. They've already lived there as a property they've rented, and now a year later they're going to own it. And there's a lot of pride that comes with home ownership. So a lease option is a fantastic way to kind of lock in that buyer. Now, if that buyer says, you know what, I don't really want to do it, that's what the option portion of it is. They have the option to buy it at the agreed upon price. And when that date rolls around, if they choose not to, they forfeit that equity, and then the landlord now gets to keep that, what would have been $500 a month cash flow. So it's the only real way the landlord loses on that situation is if the property appreciates to, let's say, 120,000. Well, then he has to sell it to that person for 105 should they choose to buy it. And if that buyer isn't if they're knowledgeable enough to know that the property is worth 120, it would be dumb for them to pass up on that opportunity of $15,000 of equity that they have now gained in the market. So that's the only real way that the landlord can lose in that situation. But uh, it really is a great way to find, an easy way to get out of a property the minute that you really get into it. So you're committed. You have a committed buyer that's going to take care of that property because if they live there, they're gonna own it a year later. So, and it doesn't have to be a year; it can be anything. The terms can be agreed upon by the renter and the landlord. They can negotiate back and forth. I've seen something as much as the buyer agrees and then puts a down payment on a property immediately. So they give the landlord like $5,000 up front, and then a portion of their rent gets saved to an additional, added to that 5,000 over time, and then they buy the property later. I've had one property where I've actually offered multiple lease options, like different options of a lease option purchase on the same property I offered it to the same tenant, and I bought the property for 160,000. I offered different lease options for 200,000, and she rejected them all. She didn't really want to commit to that, didn't want to give me any down payment, didn't want to commit to the lease option. She didn't know if she wanted to buy the property. Well, about 14 months after I bought the property, I revisited that situation. And I said, hey, I'm just curious, would you want to buy this property from me? And she said, yes, I'd be interested. And we went to the, went to the bank, and she went to the bank and got vetted and applied for the loan, and we had it appraised, and it appraised for 230,000. Now the previous price that I offered her was 200,000. And since she didn't take me up on the lease option, she missed out on that extra $30,000 of equity, because then I got an appraisal and it appraised for 230, and then I ended up selling it to her at market value. Now there was no real estate agents involved. It actually appraised for 235. So we agreed upon 230. There was no real estate agents involved, and she was a lawyer. She did all the documentation and everything. So it was actually very beneficial for me. But I would have been more than happy with a $40,000 equity increase in just a year's time. But just because she didn't agree upon it, she lost out on that extra 30. So I ended up with a $70,000 equity increase, which is fantastic. That appreciation was great. That happened over between late 2020 and late 2021 or early 2022. So that's when a lease option was very beneficial in her case, because she would have locked in that $200,000 price tag. So lease option is a fantastic exit strategy, not only for the owner, but for the renter as well. So the next one would be the 1031 exchange. This one is extremely, extremely important. I would highlight this one. I would save this clip, you name it. The 1031 exchange is a tax we've talked about in different podcast episodes, but the 1031, the 1031 exchange is called that because it is Section 1031 in the U.S. tax code, and it is an incentive for real estate investors to continuously take their money and reinvest it back into real estate. It is also referred to as a like-kind exchange, where as long as I am buying and selling and rebuying or reinvesting that money into investment properties, I can defer that capital gain. And I'm going to underline that term defer, because I am not avoiding capital gains tax. There's no way to avoid it. Eventually, what's called the tax boot of what you owe, the boot will come calling eventually, as long as when I sell that property for good, and then I'll recapture all of that deferred gain. But the underlying term is deferred. So if I buy a property for $100,000, there are certain rules which you can Google 1031 exchange rules, but I have to hold that property for 1 year. And if I sell it for $150,000, I'm supposed to owe capital gains tax on $50,000. Well, I can do a 1031 exchange and take the entire $50,000 and put it into a new property, and I don't have to pay any taxes on that $50,000. That is deferring the capital gain into a different year, and I'm prolonging it. But now I can use that entire 50 grand to buy 2 more properties, and then when they appreciate, I'd sell them both and then do it again. So now I take this very small snowball and I turn it into many more down the road. Now, this is important because if you purchase a property that, let's say, I'll give you an example. I'll use my own experience. So I'm buying a property that's a duplex for about $80,000. It doesn't need that much work, but the property maximum, even if I fixed it up completely, fully remodeled, is probably going to, which I'll invest probably $50,000 to do that. I'd be all into the deal for $130,000. The property may only be valued at $120,000 to $130,000. I'm not going to make any money on the appreciation value there. There's no sweat equity that I can make from it. So if I go into this property with the intention of a 1031 exchange, this is not a good investment. This is not a good buy. But I had bought property that had done tremendous appreciation value, and I did 1031 exchanges into these high cash flowing properties, because now my investment strategy, instead of snowballing, is to increase cash flow. This is going to increase my income rather than increase my net worth, in terms of increasing appreciation value. Appreciation value is tremendous. It can very quickly snowball your investment. But if I'm making $5,000 a month in cash flow, I can buy a property technically every 6 months. With that 30 grand, I can buy a $100,000 property every 6 months. So why would I not choose to do that? Which again is important to understand, because that 1031 exchange strategy is a gold mine when buying a property in C+ to B- neighborhoods, where you can have great appreciation value or sweat equity created and sell that property a year later and then buy multiple more. But if I'm buying in C- to D-class neighborhoods where the cash flow is really high and maybe it's lower income neighborhoods, those aren't really like high demand places. And so the appreciation value is much slower, if not even existent. So it's important that if your exit strategy is going to be a 1031 exchange, it's got to be in a place that demand and appreciation actually happens. But research that 1031 exchange, highlight that. It is a tremendous value. I have turned one single unit, one single family home in 2018 into 17 units, 8 homes in 5 years through performing two 1031 exchanges, and it has been a tremendous tool. So I highly recommend it. Refinancing would be the next one, the next exit strategy. So refinancing can be an exit strategy where an investor cashes out their equity in a property through going to a bank and asking for a cash out refinance. So if I buy a property for $100,000 and I put 20% down, and that a property appreciates to $150,000 a year later, 2 years later, let's say 2 years later, because $50,000 growth in 1 year was realistic in COVID, but now may not be as realistic. But let's say it appreciates $50,000 in 2 years. I have now a total of $70,000 of equity. The initial $20,000 down payment plus my $50,000 of growth. There's some equity pay down in there, so I'm going to round up and say $72,000 of total equity in the property. I can go to a bank and say, I'd like to do a cash out refinance. And they're going to say, okay, we'll do a maximum loan to value of X amount. It depends on the bank. Some of them will say maximum loan to value of 85%, 80%, 75%, whatever it is. So again, to make numbers very easy, if I go to a bank and the property is worth $150,000 and I'm going to use my calculator here just so I don't give you stupid numbers. The property is worth $150,000 and we do a loan to value of 75%. That is $112,500. So the bank is going to write me a check. I need to keep 40,000, what is the math? $37,500 in the property. $37,500 in the property, which means the bank is going to write me a check for about $32,500. So I've held the property for 2 years and now I get $32,500 back. I only invested 20 grand into it. I have a $12,500 profit of owning this property. I didn't sell it. That cash, because the bank wrote me a check, that is technically debt. And that's what you're going to hear from Rich Dad Poor Dad. It's debt. It's not taxable. So that's a $12,000 profit that you have in your hands that the IRS can't come after, because they come after taxes of buying, selling of an asset of capital gains. I didn't sell this asset. It's a cash out refinance. It's debt. And so you've recouped that investment, and that is your exit strategy. You can now take that $32,000 check and go buy another property that costs $100,000 with 20% down. It's a tremendous value. Now you can combine strategies as well. So what I had done is I completed a 1031 exchange. I took $100,000 of equity. I bought 2 separate properties, remodeled them, created more sweat equity, and then I did a cash out refinance and I recouped an entire I think the amount was 112,000, no, maybe about $107,000. I had a $107,000 check wrote to me after doing a 1031 exchange, increasing sweat equity, and then I did a cash out refinance and recouped it all. So not only did I defer my gain, but then I did a cash out refinance and I had a $100,000 check tax free. I mean, that's the ability to combine. And now I have, and I kept the cash flowing properties. It's a tremendous way to increase your portfolio and then recoup your investment. And then what I did is I took that $100,000 check and I bought 3 more properties, which cost me a total of 70,000, give or take. And now I have 5 cash flowing properties, and I took a 5-unit building and I turned it into, I think it's 2, 4, 7, 7 and 6, 13. So I had a 5-unit building, and then I was able to turn that amount of cash in that same building to, now I'm losing my train of thought, a 5-unit building into 13 more units and keep $30,000 in my pocket. And now the cash flow is about $4,000 to $5,000 a month across those 13 units. That I combined almost every strategy I could think of in that moment of BRRRR method, lease to own, lease to own option, 1031 exchanges, and then a cash out refinance. I combine almost every single strategy as well as creative finance through private lenders because typical banks weren't giving me good terms. I mean, it was a tremendous, year and a half, and it's been very difficult. It's been very hard. I leaned on my wife a lot for that expertise of remodeling, but it has panned out to be a good investment so far. And our properties are slowly becoming stabilized, but slowly but surely it is starting to work. And I've taken over management, and it's been pretty good. So the next one, uh, the next exit strategy would be called owner financing. So let's say I've owned a property for X amount of years, and I've decided to pay it down early, and I own it free and clear. Owner financing is a way I can turn my landlord goals and of owning real estate and kind of push that onto a new buyer. And then I owner finance, becoming the buyer's bank, and I sell that property to them, but I'm going to take mortgage payments in return rather than putting a property on the market for $100,000 and selling it to them immediately. That entire $100,000 I have to pay tax on immediately. I could do a different strategy like the 1031 exchange we spoke of, or I could do what's called owner financing. Because let's say as a rental property owner, I really, really liked the fact that I could get cash flow payments. And what do banks do? The bank's entire income and benefit is cash flow, their interest payments. That's how banks make money. And so why would I not choose to do something that the bank does? So if a buyer comes to me and says, hey, I don't have $100,000, but what I do have is 10 grand, maybe I give you 10 grand up front, and then we do, whatever terms you agree on over, the amortization period, over the term, and they could pay me monthly payments to take over my property. And now I'm 100% hands off. That person now owns the property, and the property itself is the collateral, similar to how the bank does it. And if they default, I take them to court, I foreclose the property, and now I re-own it. I keep their entire equity. All their equity is mine now. So technically, it's almost a way that if that does happen, you get to recoup your property for pennies on the dollar, should they choose to not pay, which would be dumb because very, very often owner financing deals are a great way for buyers to get into a property cheaply, as long as both people are on par with determining what terms they're going to do. Another benefit that a person would do owner financing is if I sell that property for $100,000 immediately, I'm going to owe taxes on that $100,000. That is income now. But what if I pay taxes on a set income from the payment? So let's say the person is going to pay me $500 a month at a 3% interest rate. Well, I'm only paying taxes on the money that I'm making in that year. So $500 over the course of 12 months, we're talking about 6 grand. And I believe there's even, again, you're going to have to talk to a CPA, but you're only paying taxes on, I think, of what you have made on that money. So if I bought the property for 100,000, I'm selling it for 100,000, and I'm doing owner financing, and I don't pay any taxes on the original 100. But if I do owner financing at a 5% interest rate, I'm going to pay taxes on the income that I make. And that is a way that, let's say the property appreciates to 120,000. I sell it back to him at 500 a month with interest payments. I'm going to pay taxes on that 20 grand, but not immediately. I'm going to defer it over the course of the life of the loan because I don't recoup it all in the same year. So it's a great way to keep your tax burden low and not, skyrocket you to multiple different tax brackets. So something to really consider is owner financing. If you own a property free and clear that you may not want to pay taxes on, you like the steady cash flow payments. The next one would be auctioning your property. Now, this is where we get into something where you may just have to cut your losses. If selling a property in an auction can be a quick way to unload the property, this is particularly useful for properties that are hard to sell in a traditional market due to issues like poor condition or sluggish in the local real estate market. So if the demand isn't there, you may be willing to put your property up for auction to take it for pennies on the dollar. Plus, some auction sites may take 10, 20% of the revenue. But, if you have a $100,000 property that's been on the market for 150 days, well, obviously the demand's not there. Something's wrong. Either it's listed too high or it's just a crap property. And so you would just take it to an auction, and auctions would try and get what they can for it, or you need to come down on your price. So an auction is just a way to cut your losses. The next way would be a short sale. So a short sale, obviously, you have to go through the bank. So technically, what a short sale is a bank's approval. You and the bank agree that the bank is willing to lose money on that property because they want to recoup that money and get it out as quick as possible. This would happen, my guess, as I've never been involved in a short sale or anything, but my guess is any logical person would know. If I'm the bank and I have an outstanding mortgage for $200,000 and it's a 3% interest rate, it would be worth it to me to let that property sell for 180,000. So I'm going to lose 20 grand on that property. In order to me get that 180 very quickly now, I can re-lend that 180 out at the current 7, 6, 7, 8% interest rates through auto loans, more other mortgages or whatever, to find another qualified buyer. So that's my opinion. It is that of why a bank would do that so quickly and be willing to. So a short sale is when a bank is willing to lose money on their mortgage and it sells for less than what the mortgage is worth. The buyer is going to be underwater no matter what. The bank isn't going to let the buyer walk away with any equity after a short sale. It doesn't even make sense. It's not technically a short sale then because the bank is made whole. A short sale is when the bank loses money on that deal. But the bank is not in the business of owning real estate. And that's what a lot of people need to understand. Bank is in the business of lending money and making money on that lent money. The bank is not in the business of owning real estate. They will lend you money to buy real estate, which is why real estate is such a good investment. They won't lend you money to do anything else other than start businesses. So businesses and real estate. So the next one would be a typical buy and hold. So a lot of people think that, you need to get your money, like sell your property in order for it to be an exit strategy. But really like I said before, the term exit has to do with your getting ability to get money back. And so someone may say, you know what, I have done this to get X amount of money. I'm going to take that money. I'm going to buy and hold this property and I will never sell. That is technically an exit strategy because you have no intent to sell that property to get anything back. Your exit is receiving the cash flow payments. And so if you have a 10% return on investment, you'll get your money back after 10 years or, maybe 11, 12 after some maintenance issues. But you're going to hold that property for such a long time. And then when the market shows itself or you pass it along to a family member or whatever, the peak of the market presents itself, you may choose to sell. And obviously that could be a exit, but buying and holding is a proper way to plant your money and call it an exit strategy. So those are many, many different ways that you can maximize your benefit of, getting out of a real estate deal, or at least getting your money back in a real estate deal in order to snowball it into bigger and better things and more properties. So I hope this was very helpful for you. I'm glad you guys tuned in. I'm glad you're listening. Let me know what you think in the comments. Please follow me on all socials, Instagram, Twitter, Property Pilot Podcast. If not, you can find me at REI Brian 5 on X. I always say Twitter, but I guess it's X now. But I appreciate you guys listening. This was episode 21 of different real estate investment strategies. Always remember, it is never a bad time to buy real estate. I will see you guys next week. Have a good one. Thanks. The advice and recommendations I offer are intended to be informative and educational, drawing from my own experiences in the real estate market. It is crucial to recognize that every investment decision carries risk and outcomes may vary. I am not a financial advisor, and the information provided during these podcast episodes is not intended as financial, legal, or professional advice. It is your responsibility to conduct thorough due diligence, seek the advice of qualified financial professionals, and make informed decisions based on your individual financial situation and goals.